Namaste, good morning. Let's go ahead and complete the remaining parts of capital gain and walk into income from other sources now. Well, before starting to complete the comprehensive questions, let me look into some of the very few of the case laws which gets overall importance, not specifically, but overall importance. In the background of the case law also to a little extent. The first case law is on the holistic aspect of what is meant by transfer, or will this even be regarded as a transfer. In this case law, the facts goes like this, my dear friends. A company entered into another company an agreement to sell or develop a property. Please understand, a company entered into an agreement to sell. In that agreement, a consideration has been fixed and it will be paid in 10 installments, after which the sale will be registered in the name of the buyer. All the 10 installments payments are over. All the 10 installments payments are over. Still, the registration is yet to be made. All the 10 installment payments are over, but the registration is yet to be made in the name of the buyer. Is it still transfer? And can capital gains be computed, or when capital gains will be computed? The answer the Supreme Court gave is yes, it is transfer. What is transfer? Sale, exchange, relinquishment, compulsory acquisition, conversion of asset into stock in trade. And then comes a unique type of transaction. Then comes a unique type of transaction which we are all aware. Transfer of possession on partial performance of a contract. Transfer of possession on partial, those sales which are taking place through power of attorney basis. Those sales which takes place through POA are covered in that particular transaction. So, here is an example that the sale took place through POA. The physical possession has changed. The physical possession of the property has been given to the buyer. Only the last part of the formality, and the buyer has paid the full consideration. The last check is also realized. Only what is pending is a formality of the contract. Hence, it is said that the transfer is already complete. The transfer is already complete. What constitutes transfer in relation to a property immovable which is proposed to be sold, contracted to be sold? The wordings of section 247(6), that's what I said. Transfer by partial possession appears to bring into tax net of all rights over the property even without transferring the ownership. When you transfer the right over a property, even if you don't transfer the ownership, it is taxable. The expression enabling the enjoyment means getting all rights over the property through other means. Other means POA and actually getting title deeds. Hence, the substance of the transaction is fulfilled. Capital gain arise when the consideration is received fully on handing over. Okay, till the last I accept the consideration. Once the 10th installment, in the given example, once the 10th installment is provided, that means the consideration is received fully. Once the consideration is received fully, then capital gain arises. This is part of law. Okay, this is part of law itself. If we look at transfer, we will understand. Okay, if we look at transfer, we will understand. Sale, exchange, link, extension, etc. Okay, transaction allowing partial possession of the contract. So this is part of law which was clarified by the Supreme Court. Can you please mute? Somebody is unmute. Can you please mute, friends? Next is the case law which we have already seen in the classroom. More than as a case law, we have already seen in the classroom. When is the capital gain, when is the acquisition computed? From the date of leasehold or from the date of freehold? We already know leasehold. Conversion of leasehold into freehold is not acquisition, is just like an improvement. Leasehold versus freehold. Whether amount paid by the assessee for getting perfect title of property, conversion of leasehold into freehold, be treated as cost of assessee is entitled to get this deduction for the amount paid. Such amount paid will be considered as cost of acquisition. In one other case, they said cost of improvement. Anyhow, the indexation benefit is available for conversion of leasehold into freehold.
Sir, I have a doubt, sir.
Go ahead with your doubt.
Sir, in first case la வந்து part of payments receive பண்றப்போ preceding year la அந்த payment receive ஆயிருந்தா அது எப்படி சார் tax பண்ணுவீங்க? அதோட tax effect.
I understand your doubt like this. That is total consideration. Let us take 10 crores. Every installment I receive 1 crore, so totally 10 installment. In the financial year 2021, I have received 5 installment. Here, no taxation. Okay, transfer has not yet taken place. In the financial year 21-22, okay, I received the balance 5. Okay, but don't transfer the title deeds. Okay, not yet transfer. Okay, transfer completed and taxed in FY 21-22. If your question is, in this year I have received 5 installment, in what way we will tax it? We will not tax it in that year. Only when the last of the installment is paid, the complete control over the property goes to the buyer, and the formality of registration is not essential. When part of the installment is only paid, we cannot call it as partial. Partial performance does not mean every part as such. Partial performance means the buyer has completed his entire obligation, only the registration or other formalities are left. Is my understanding of your question right?
Right, sir. Clear, sir.
Balakrishnan, his agricultural lands were acquired by the government, my dear friends. his agricultural lands were acquired by the government. And the government fixed the compensation. He went to the collectorate office and said, the compensation is very low. If I go for the appeal, it will be increased and it will unnecessarily be a litigation for longer period for both of us. We will be incurring cost. Instead, the compensation was negotiated with the collector. The collector increased the compensation and paid to the assessee. The assessing officer now contended that since you have negotiated the consideration, it will not be treated as compulsory acquisition, and I will not provide 1037. Please understand. Compulsory acquisition of urban agricultural land from an individual, we all know, is exempt from taxation under section 10, subsection 37. The contention of the assessing officer is, you have negotiated, okay, the compensation. So now it loses the character of compulsory acquisition. It comes in the context of voluntary compensation. So I will not provide you exemption. Okay. Trust me, case went up to Supreme Court, where the court said, when the proceedings are under Land Acquisition Law Act, when the proceedings are under Land Acquisition Act, now the act is slightly changed but the same provisions. Even if compensation is negotiated and fixed, still it would be compulsory acquisition. It doesn't change the character of. What I try to avoid is litigation. But it does not change in any way the nature of acquisition by the buyer. So, when it is under Land Acquisition Act, when the property is acquired under Land Acquisition Act, that itself is a sufficient proof that it is a compulsory acquisition and exemption needs to be provided. Again, another case law which is not, I don't know why it went even to High Court. Ragji Bhai Nagji Bhai Tisia. AO referred the case to valuation officer, saying, I am having doubts on the valuation, can you just check? Meanwhile, completed the assessment without considering valuation officer's report. AO only referred the case to VO. He completed the case without considering the VO's report. The question is the AO correct? The answer is no. AO is not correct. When it has been referred to VO, you are supposed to consider VO's report. Capital gains needs to be computed only in conformity with the report of the valuation officer. The question, the contention of AO is wrong. I am not continuing with this case. We have done questions itself in this particular case. Okay, we all know when the cost of the previous owner is taken, when the holding period of the previous owner is taken, the cost of acquisition benefit should also be treated. We all know about this particular 54 exemption. Assessee should have purchased or constructed a house in India within specified period of time. Specified time period means in case of purchase 1 year before or 2 years after the date of transfer. In case of construction, it should have been completed within 3 years. In case of construction, it should have been completed within 3 years. Can I start the construction before selling the property, friends?
Yes, sir.
Yes, sir.
Yes, sir.
Yeah. I'll tell you the whole issue. Only if I sell the property, capital gain will come. Only if I sell the property, capital gain will come, and that can be invested. Before selling the property, if I am investing, that means it is not capital gain. It is my salary income savings or any other income savings only which I am investing. Now tell me, are you still holding your answer that you can claim?
Yes, sir.
Yes.
Yes, sir.
Yes, sir.
Always remember, one-to-one correlation the law is not expecting. One-to-one law correlation the intention danga. My intention is to provide you exemption if you invest. Law's intention is to provide you exemption if you invest. And you have invested. And I will provide you the exemption. Nowhere the law has said that construction should not start before 1 year before. With regard to construction, the completion should be within 3 years. Assessing officer contended purchase the law has said 1 year before, but for construction they have not said. It is understood. Completion date only they are giving. Start of construction should be after the capital gain arises. The law has not said so. Okay. Okay. Ariyama. Okay. Sundaram is a very, very famous lawyer himself. The question in front of law, whether cost of purchase of land and cost of construction incurred prior to transfer of previously owned property would qualify. High Court held Section 54 does not lay down that construction could not have commenced prior to the date of transfer. It also does not contemplate that the same money should be used for should be utilized for purchase or construction. Hence, exemption cannot be denied. Remember, one-to-one correlation law never expects it. Law never says the same money should be utilized. Okay, and for construction, end date only is specified. We slightly know this case law in the classroom. Adjacent flats, adjacent apartment, Syed Ali Adil. Okay, I told you, a common meeting point. If you remove the wall or a common meeting point is there, that is sufficient. Assessee is entitled to get exemption for both properties since it is adjacent to each other and had a common meeting point, thus making it as single property. In one other case law, which is not a recent case law now, but in one other case law, the question in front of the law, two adjacent apartment, removing the common wall, so it became, but sale was through two transfer deeds. We are going to a person who is constructing the apartment. He will sell us through two transfer deeds, two house property, but he will remove the in-between wall. So can it be considered still a single unit or two units? The court held it is still a single unit. There can even be two stamp papers or two deeds. But what this is, okay, adjacent to each other and have a common meeting point. Then it will become a single property even though it is transferred through multiple deeds. Next. These are all the subsequent case laws which talks about co-ownership. Let us, before going into the case law, let me give you a heads up on that. A person sells a property, house property, and buys a house property, he will get section 54. The property purchased is in joint names, person and his son, person and his spouse. Can exemption be still claimed? The answer is yes. It can still be claimed. The exemption can still be claimed. The answer is yes. Intention is fulfilled, investment. Just because it is invested along with the joint name, it does not mean you will withdraw the exemption. In one other case, the law went one more step ahead. Seller and the new property was purchased exclusively in the name of spouse. New property was purchased exclusively in the name of spouse. Can exemption be claimed? The law said yes. Intention is to invest. You have made a property, you have purchased the property. And we all know house property chapter, okay? It is spouse also, the income will be clubbed in the hands of the assessee. Even if it is spouse, the income will be, the legal owner being spouse, the deemed owner becomes assessee. So income will be clubbed in the name of assessee. So there are provisions to safeguard that. So it should be provided. Reverse example. Property sold is a joint property. Property sold is a joint property. Investment is made in the name of one person itself. Property sold is a joint property. Investment, the new property is purchased in the name of only one person. Can still exemption be provided? Yes. Ella case law court has held. Why we are giving exemption? We are giving exemption because we want to promote assessee to invest. We want to motivate assessee to invest. If investment condition is fulfilled, other small slips or other small aspects should not be looked into. Investment is the superior aspect here. You will see in Hindustan Lever's case, investment is made in bonds. Check was given. but the bond was dated after 6 months. Can I still claim it? Yes. One of the conditions within 6 months, that will sometimes be also overlooked because your intention is fulfilled. Construction should have been completed within 3 years. Not yet completed, sir. Some more works are pending in the building. So completion certificate is not with me, but I have invested the capital gain. The court said, take it. He has invested. The property is not yet, construction of property is not yet completed. That doesn't mean he will be denied. So even though when you read the law, you understand that 3 years time period, etc. When it comes to interpretation, there is a liberality. Saying, if the condition of investment is fulfilled, then provide the exemption. Sale by co-owner, but investment made in the name of single owner. Merely because assessee's son name is shown in the sale deed, it does not make any difference and assessee is eligible to claim the exemption. New investment exclusively in the name of spouse. 54F is liberal and beneficial to the assessee. It only specifies that assessee should have investment, and nowhere it is mentioned that investment should also be in the name of assessee. Having regard to the rule of purposive construction and the object of the enactment, that is where interpretation is a bigger role in law. Object of the enactment is to promote assessee to invest, to develop housing sector. The small formalities of in whose name it is getting registered. You have earned a capital gain, invested, you will get it. Okay. Having regard to the purposive construction and object, it is held assessee can claim exemption. Ravindra Kumar Arora. Whether investment in joint names will also qualify? Yes. Same judgment. Section 54 mandates that assessee should have purchased the house property. It does not specify. Different high courts. In the name of the assessee. Inclusion of spouse name will not deny the benefit. Condition stipulated stands fulfilled. Construction not completed within 3 years. Can exemption be withdrawn? Sambandham Udaya Kumar. 54F is liberal and beneficial. If assessee has invested the money, exemption cannot be denied merely because construction is not completed in full and possession not handed over. So all the case law leading to the same point, my dear friends. What is superior is assessee should have invested. What is superior is assessee should have invested. No correlation, and the names appearing in the deed are not important. If those the intention of the legislation is fulfilled, then the law will be liberal to give you the exemption. This is one of the stunning case law of interpretation. What is coming up? is a stunning case law of interpretation. This is not in just case law. முன்னாடியே there was another case also. Investment in certain bonds, 54 EC. Asset transferred should be long-term, should be land and building, which is a long-term capital asset. Asset transferred should be a long-term capital asset. To enjoy the benefit, asset transferred should be a long-term capital asset. Otherwise, this benefit is not provided to the assessee. Depreciable assets, whether it is long-term or short-term.
Short-term, sir.
Short-term. So, if I sell a depreciable asset and invest in bonds, whether can I get 54 EC exemption? If I sell a depreciable asset and invest in 54 EC,
yes, sir.
Can I get exemption? Look
yes,
at
sir.
that. Yeah, good friends. Look at the interpretation. I have a building from the year 1011. Repeating. From the financial year 1011, I have that building. The opening WDV of that building is some amount. I sold that building. I got what is known as short-term capital gain. Our friend is right. Depreciable asset, short-term capital gain. I invested in bonds and claimed 54 EC. Assessing officer denied, saying that it should be a long-term capital asset. In the given case, you are only getting short-term capital gain. So we cannot or we will not provide exemption. The court interpreted like this. Section 50 is a computation mechanism. Shall I repeat? The court said Section 50 is a computation mechanism. It is not a classification mechanism. Classification is different. Computation is different. One asset, whether it is long term or short term, depends upon the period of holding. This building which the assessee has sold is a long term capital asset because it is held for 10 years, more than 36 months. So it is a long term capital asset, but in computation, the result is STCG. It is a unique circumstance of an LTCA giving STCG. Normally LTCA, LTCG, STCA, STCG, but here is a unique case. This building is there for more than 36 months. So it is a long-term capital asset, but when I come to section 50, block ceases to exist and the resulting gain is short-term. Now coming and reading the condition, asset transferred should be land and building, which is regarded as not long-term capital gain, which is regarded as long-term capital asset. Yes, it is a long-term capital asset, but the result is a short-term capital gain. It's okay, you cannot deny the exemption. The law said yes, exemption has to be provided. Assessee sold depreciable asset and invested in bonds. AO denied the exemption on the grounds that 54 EC is available only for LTCA. By virtue of section 50, what arises is STCG, hence exemption is not available. Held by the court, assessee can claim the exemption. Mode of computation is different from classification. If an asset is held for more than 36 months, it is a LTCA, and the mode of computation says it is providing STCG. If invested in specified bonds, exemption cannot be denied. It's a very good case law. This was even before this case law. There was one other case law which gave the benefit. It's a fiber board case law. Something.
Sir, I have a doubt.
Go ahead.
If suppose opening WDV has both the long-term and short-term asset, and the asset sold in the current year, in the previous year was short-term asset, and that and the sale consideration exceeds the value, I mean the block value. In that case, we cannot consider that sale as sale of long-term capital asset. So in this case, we cannot claim 54 EC, right?
Your question is, the asset itself is held for less than 36 months and it's
Yes, sir.
also giving a STCG. In that case, no, you cannot claim. If the
So
asset sold is a
even in
long-term
any
capital
future.
asset,
Okay.
then
Okay, sir.
only it can be claimed.
Okay. Thank you.
If you want to extrapolate a question, if suppose I have two buildings, that question I'm just telling you. One building is a long-term capital asset, another building is a short-term capital asset. I only sold that second building and the block ceases to exist. I got short-term capital gain, I invested. Her question is, can I claim 54 EC? No. Asset classification is different from computation. As per classification, what should have been sold is a long-term capital asset. Then only 54 EC can be claimed. Imagine this circumstance. Sale consideration ₹50 lakhs. Stamp value 60 lakhs. Capital gains 20 lakhs. Investment made, okay, 54F. We all know net consideration has to be invested 60 lakhs. Can I claim the entire capital gain exempt? If the whole of the net consideration is invested, whole of the capital gain is exempt. Sale consideration is 50 lakhs, stamp value is 60 lakhs, section 50C is applicable. So whichever is higher, so 60 lakhs, 110%, more than 110%, 60 lakhs will prevail. That becomes the net consideration. I get a capital gains of 20 lakhs. I invested the entire 60 lakhs. Can I get entire 54F exemption? Venkatesh?
You should get, sir.
Yes, sir.
Yeah. Assessing officer contended like this. Please understand. Your sale is only 50 lakhs. How come you invested 60 lakhs? Assessing officer said, when your sale is only 50 lakhs, by applying section 50C only you got 60 lakhs as sale consideration. It is deemed. When your sale is only 50 lakhs, how come you invested 60 lakhs? Assessee said, sir, I had some IFOS. I invested. Adikalla enal exemption. I cannot give exemption for those things. I can only give you exemption for capital gains. So exemption, assessing officer said is I can only give 5/6 of 20 lakhs. Okay. I can only give 5/6 of 20 lakhs, somewhere around 16 lakhs, and not the entire 20 lakhs. Is the assessing officer correct?
No, sir.
Wrong.
No?
Net
No,
consideration.
sir, but anyway, he has got 50 lakhs, out of which only he has invested. So anyway, the 20 lakhs is already covered.
Sriram, நீ முதல்ல ஆரம்பிக்கலாம் நீ சொன்ன ஆன்சரை. Sir, he
Sir,
got 50 lakhs. Out of this,
sir,
how
he
can
has
he invest
received
60
50
lakhs,
lakhs.
Sriram?
The computation
No,
of
sir.
full value consideration
No,
is
sir,
different.
I am saying he has got money from other sources, but the 20 lakhs of capital gain is already covered in the 50 lakhs, right?
Is already covered. Had I taken 50 lakhs as consideration, I would have only had 10 lakhs as capital gain. Since I took 60 lakhs, the capital gains comes to 20 lakhs.
Yeah, because you have advised that stamp value should be taken as net consideration is only why it's 20 lakhs. If not, the actual capital gains would have been only 10 lakhs.
Yes, accepted.
Sir, I guess it should be like saying similar to that other case law that the computation of full value of consideration should be different from this 54F, the net consideration.
No, Antonio, some other answer. Okay. I thought somebody will answer that with the same wordings. I'm always saying one-to-one correlation is not essential at all. One-to-one correlation in the paisa, this money only should be equal to this. One-to-one correlation is not essential. What is superior is investment. One-to-one correlation is not essential at all. What is superior is investment. Further, the court held. When you take a deemed consideration, illada paisa you are taxing. This 10 lakhs I have not received. The money which I have not received, you are taxing. When you are taking the deemed consideration, what will the assessee do but to invest that consideration from other arenas? Gauli Mahadevappa. It is not D, I will change it. It is I. Gauli Mahadevappa. Stamp value was adopted as full value of consideration. Assessee invested on sale consideration of 54F. AO mentioned that only up to sale consideration assessee has invested for capital gain. Amount invested in excess of sale consideration is from other sources and exemption cannot be provided for it. When capital gain is computed on deeming provision, the whole of the amount invested will be eligible irrespective of the source from which it is invested. Bonds issued, I told you, yes, even if it is after 6 months, exemption can be provided. And the last of the case law, the advance paid also come under 54G. The case law unacceptable. Okay. Assessee transferred from urban area to rural to a non-urban area, transferred land, etc. from here and paid advance in that other non-urban area. Assessing officer contended that the section says you should have purchased. So advance paid, I will not provide the exemption.
Sir, but all other expenses can be claimed.
Yeah.
Typical AO.
AO denied exemption specifying purchase will only qualify and not advance paid. Giving advance for acquisition of eligible capital asset is a sufficient satisfaction. Hence, exemption cannot be denied. இது Supreme Court. எவ்வளவு வருஷம் ஆயிருக்கும்? 16 to 20 years. It would have taken 10 years minimum. Just quickly read through the case laws. I'm going to the completion of the remaining questions, by which we can also complete that chapter. I'm in question number 42. Vijay, an individual, owned 3 residential houses which were let out. Besides, he and his 4 brothers co-owned a residential house equal share. He sold one residential house owned by him during the previous year. Within a month from the date of that sale, the 4 brothers executed a release deed in respect of their share in the co-owned residential house in favor of Vijay for a consideration. Vijay utilized the entire long-term capital gain arising out of the sale of the residential house for payment of consideration to his 4 brothers. Vijay is not using this house in respect of which its brothers has executed for self-occupation, but he has let it out to another person who is using this house. Is Vijay eligible for exemption under section 54 for the assessment year in respect of the LTCG arising from the sale of his residential house, which he has utilized for acquiring the shares of his brother in the co-owned house? Will the non-use of residential property for self-occupation disentitle him from the exemption? Read through, I'll explain. Understand the circumstance. Vijay sold house property, got LTCG. Vijay is a co-owner of another HP along with 4 others. Vijay settled all the 4 others with the LTCG on sale of HP and got this co-owned property as single owner property. Vijay ensured that he settled his 4 brothers with the LTCG he got from here, and that money he has utilized for settling his 4 other brothers and got this co-owned property in the single-owned property. This property, which he got it as settled, is also let out and not self-occupied. Can 54 be claimed?
Cannot, sir.
Why?
He owned more than 2 house properties, sir. 3 residential house.
He owns more than 2 house properties. He is already the ownership of 3 or 4 house properties. And the condition in the section la Venkatesh, Which section imposes that condition? Is it 54 or 54F?
Not 54, sir.
Huh?
Not 54.
So,
It's 50.
only 54F has the condition of he should not be owner of more than one property. So, it is 54F has that, not in 54. So, now come back to the question, Venkatesh. Answer, can 54 be claimed?
Sir, he is also a co-owner, so it is not a another house, another property. It is a deemed it is like a deemed property of him. So
our friend Venkatesh and the assessing officers are contending, you haven't purchased a new property. You have not purchased a new property. You have used the money just to settle your co-owners of your existing property. So I will not provide you exemption.
But that's not correct, sir, because he is purchasing the other 3/4 of the share, where his money, what he earned through the sale, he is investing, and even the title deed, it's not going to be a share title deed, but a sole title deed. So it will not be, say, the assessing officer is incorrect, and there will be exemption has to be claimed.
So the judgment or the understanding is also that it's not a recent case law, so not even a judgment, the understanding. Please understand, okay? Let me ask the reverse question to you, Venkatesh, for a minute. You and me are co-owners of a property, Venkatesh. You and me are co-owners of a property. I am relinquishing my right. Now, I don't want to be the co-owner. You pay me certain money so that you become the single owner of the property. You pay me. To me, in which head it is taxable?
So it's like a transfer. Relinquishment is like a transfer, so it is a capital gain, right?
For me,
yes, for
it
you.
is a capital gain.
Yeah.
For you, it is cost of acquisition, correct?
Yes, sir.
Vijay settling 4 others.
Okay.
Is cost of acquisition. Just one example you can understand. We both here, for me, it is taxable under capital gain. I hope you don't have any doubt. For the payer, then what it is? It is cost of acquisition. For the payer, it is also cost of acquisition. So, settlement of co-owners will be treated as capital gain, will be treated as purchase of a new property.
Okay.
So exemption should be provided on that basis.
Okay, sir. Yeah.
Cleared,
sir.
The property which he got settled is not let out, but I mean, it's not self-occupied, but let out. Can exemption be denied?
I think not, sir.
Why?
He can claim.
Why?
Because he doesn't transfer his ownership, right? It's a letter property. If it is a long-term lease, the ownership substance.
Okay, I get that answer, but the simplest answer is nowhere the law has said that
why
the
what they are
newly
using
purchased
for.
or acquired property should be self-occupied by the assessee. We did not say it. It should be within specified time period. That's all. So coming to the question, my dear friends, okay. Payment made to co-owners for obtaining clear title of property in the name of the assessee will be regarded as cost of acquisition for the assessee. Payment made to the co-owners to get clean title of the property in a single name will be treated as cost of acquisition for the payer, for the assessee. Hence, the investment criteria is fulfilled. The investment, you should invest a long-term capital gain in a new asset. New does not mean that it is the first time you are using. Existing second-hand asset also for you, it's a new asset. Law does not specify that the new asset should have been, or that the invested asset should be utilized by the assessee for self-occupation. Law is not specifying that whatever you have invested, that asset should be self-occupied and all. The law does not specify so. Hence, exemption cannot be denied. Question number 43. Ankit sold a plot of land during the financial year 21-22 and invest the sale proceeds in the purchase of new house in the name of his wife by the end of the financial year. He claimed a deduction under section 54F in respect of the new house purchased by him in the name of spouse. Assessing officer, while making the assessment, denied such deduction on the ground that in order to avail the benefit, it is necessary to invest the sale proceeds in the name of the assessee. Comment on the validity.
So, like the case law we saw, it has to be not necessarily invested in his
Yes,
own
sir.
name. So,
Beneficial ownership.
In your notebook also, write this / Ravindra Kumar Arora. Okay? Okay. Investment is the section 54F is liberal. Investment is the criteria, not in the name in which you are investing. Anyhow, assessee is going to be the deemed owner of the property, so exemption cannot be denied. On 31st Jan 2022, Mr. A has transferred self-generated goodwill of his profession for a consideration of 70,000 and incurred expenditure of 5,000. You are required to compute the capital gains in the hands of Mr. A. Question number 44. For self-generated goodwill, the cost of acquisition will be nil.
only if it's purchased, we can take a cost.
Yeah, for the self-generated goodwill, cost of acquisition will be nil. The entire consideration received after providing for expenses will be taxable in the hands of the assessee. not you who are asking any question. Tani purchased a loan at a cost of 35 lakhs in the financial year 2005-6 and held the same as capital asset till 31st May 2020. Tani started a real estate business on 1st January 2020 and converted the said land into stock in trade of her business on the said date when the fair market value was 210 lakhs. She constructed 15 flats of equal size, quality and dimension. Cost of construction of each flat is 10 lakhs. Construction was completed in January 22. She sold 10 flats at rupees 30 lakhs per flat in January 22 and March 22. The remaining 5 flats were held as stock in trade in March 22. He invested 50 lakhs in bonds issued by NHAI and another 50 lakhs in the bonds issued by REC. Compute the capital gains and business income arising in the hands of Tani from the above transaction, indicating clearly the reason for your computation. Question is yours. Question is yours. Start doing. This is how my computation goes. If an asset is converted, stock in trade, it is transferred. Fair market value on the date of consideration, conversion will be full value of consideration. Capital gain will arise only when the stock is sold. So in this case, the full value of consideration, the capital gain is 1 crore 19 lakh 95 726 or something like that. Full value of consideration 210 less ICOA, I am getting this. Okay, but this is for 15 apartments. This is for 15 apartments. Only 10 apartments are sold. Correct, Matthew, Shaji. Yeah. Only 10 apartments are sold. So for 10 apartments, how much is the gross gain? Minus exemption will give me my net taxable capital gain.
Sir,
Raja?
I have a doubt, sir. That another 50 lakhs, if we sold that 5 flats in April, then invested in REC.
We can claim in the next year. Yes, your doubt is correct.
Sir, how, sir? We transferred only one house property, no, sir?
We transferred only one house proper. Oh, okay. Yeah. For one asset, only one exemption can be claimed. Only once it can be claimed. Yeah, you're right. For the remaining 50 lakhs cannot be claimed. 50 lakhs is a maximum cap limit and you cannot claim the balance 50 lakhs. You're right. It is only one house property.
Thank you, sir.
I'll also check once with the answer. It's an institute exam paper. And this is the capital business computation. I hope everybody is completed. I can progress. We have done the 46th question, 47th question. From the following details of Mr. Mohan, okay, we'll identify the various aspects. Rental income from property at Bangalore, 3 lakh standard rent, fair rental value. Municipal and water taxes for the current year and arrears. Interest on loan borrowed towards repairs of the property. Arrears of rent of 30,000 received during the year was not charged tax in the earlier year. Following additional information regarding sale of a property in Chennai. Mohan's father acquired a residential land in April 2006, 125. Thereafter, gifted it to Mohan in the same year. Fortunately, there is not going to be a law as per Manjula Gesha, because it is purchased in April 2006 and gifted in March 2007. So within the same year, no issues at all. Above said Chennai property is sold by June in the previous year for 35 lakhs. Stamp duty paid by the purchaser were 12% of stamp value, which amounted to 4,80,000. Out of the sale consideration, Mohan purchased two additional adjacent apartments in the same building, made suitable modification to make it as one unit. The investment was made by separate sale deed, amount being 8 lakhs and 7 lakhs. This apart, Mohan also invested in NHAI bonds on 10th October 21 for a value of 10 lakhs. 10th October 21 for a value of 10 lakhs. Compute the income, compute the tax. Read through once. First, let us compute capital gains. Full value of consideration. Actual sale value 35 lakhs. Stamp value, the information given is 4,80,000 stamp duty was paid, which is 12%. The information given is 35 lakhs actual stamp duty paid by the purchaser of the property at 12% of stamp value amounted to 4,80,000. So what will be the stamp value? 4,80,000 divided by 12%, 40 lakhs. 110% of actual consideration, 110% of actual consideration, 38 lakh 50,000, 38 lakh 50,000. Since stamp value exceeds, okay, 110% of actual consideration, stamp value will be regarded as full value of consideration. Stamp value will be treated as full value of consideration. So I get 40 lakhs. So I get 40 lakhs. Repeating, actual sale value 35 lakhs, stamp value 48 lakhs, 110% of actual consideration, and the stamp value exceeds 110, where the deviation is beyond 10%, stamp value, whichever is higher, actual sale value or stamp value, whichever is higher. Property purchased in 6/7 for 1,25,000 less ICOA 1,25,000 into 317 divided by 67, 2122. 122, this is year of acquisition, okay, as well as year of gift. So you don't have two answers. 1,25,000 into 317 by 122. Gross LTCG. Exemption under section 54. Exemption under section 54. In Syed Ali Abid case, it is Adil case, it is held that two different properties having a common meeting point will be regarded as single property. In this case, even you can compute for two properties because gross LTCG is less than 2 crores. But the question asks us to refer to that case, we should refer. Will be regarded as single property even if it is by two sale deeds. That is not an issue at all. So, actual amount invested, 8 plus 7, 15 lakhs. Okay, 8 lakhs plus 7 lakhs. Okay, 15 lakhs. Gross LTCG, we all know 36, 75, 205, whichever is less, so it goes to 15 lakhs. Exemption under section 54 EC, bonds, specified bonds invested within 6 months, please change it to October, okay, October 21, 10 lakhs. Taxable LTCG, computation of total income. Yeah, time to learn house property. We have been learning house property in every chapter. Nothing to worry. It is interesting to learn into smaller part. Okay, house property. The question says, he has let out house property for 3 lakhs, which is higher. Standard rent and fair rent. This is higher, so we should always consider that. Okay. Rent 3 lakhs. Okay. Rent 3 lakhs. Less municipal taxes paid. In house property chapter, there is one thing which we all have to understand. Municipal taxes will be allowed. Municipal taxes means whatever taxes paid to the state government, water tax, property tax, everything. Okay, municipal taxes will be allowed only in the year of payment. It will not be allowed on accrual basis. It will be allowed only in the year of payment, and whatever paid is allowed. Okay, this is allowed only in the year of payment. If arrears are accumulated and paid, the whole amount can be claimed in the year of payment. If arrears are also accumulated and claimed, then also you claim. Nothing wrong. So in this case, I will claim this 35,000 and this 150. Even though it is arrears, it would not have been allowed as deduction in the past years. So I can claim both the 35 and 150. 35,000 plus 1,50,000. Arrears of rent received. Arrears of rent received 30,000. This is minus. So my net annual value will be 1,45,000. My net annual value will be 1,45,000. Standard deduction at the rate of 30% of NAV. 1,45,000 into 30%. Interest on borrowed capital. Interest on borrowed capital. Okay, 1,50,000. Interest on borrowed capital, 1,50,000. So I am getting an house property income loss of 48,500.
Sorry, one doubt.
I'm waiting for that doubt.
Loan on repairs, sir. Repairs, how can we take it, sir?
Yeah. Any other
Is
doubt?
it?
I thought there will be one doubt. Sir, repairs means it is restricted to 30,000, sir. But you are claiming the entire 1,50,000. But the doubt is whether can repairs be claimed. I will clarify both.
I think it's because it's self. It's given for rental, so you can
Very
claim.
good, Antonio. Very good. Your answer is right. Interest on borrowed capital. Borrowal can be for the purpose of purchase, construction, repairs, or renewal, you can claim. In the case of let out, whole of the interest can be claimed. That's why I claimed fully. I have a doubt. Can house property loss be set off against the LTCG?
No,
It should be only carry forward. That's what you say, Sriram.
that's
No,
for
so
a
it gets
period
set
of
off against salary.
It can be set off only against
Salary.
salary. House property loss can be set off against any income. Repeating, though we see later in the chapter, difference between set off and carry forward. Set off within the same year. Carry forward, take it to the subsequent year and adjust. Set off can be against any income, but once you carry forward, it can be only against the same head. So, with regard to set off, it can be against any income. The answer is yes, house property loss can be set off against the LTCG. Okay. Normally, what we do is rounding off of income. We take it as 11, 26, 7, 10. To the nearest 10, we will round off 11, 26, 7, 10. Computation of tax. Computation of tax. Where there is a shortfall, nothing but deficit in basic exemption limit, then the same can be adjusted against the LTCG. The balance is taxable at 20%. In the given case, there is no other income, hence the entire rupees 2,50,000 needs to be adjusted against LTCG. So, taxable LTCG will be 11,26,710 minus 2,50,000. Okay. And tax at the rate of 20%. Add HEC at 4%. Total tax payable. let's start to the next question. Mr. Prajapati intends to sell a piece of urban land held for 48 months to Mr. Vasan for a consideration of 2 crores in Feb 2021. The asset has been held as investment by him. Both parties are willing to enter into a written agreement in this regard. Initial payment will be 40 lakhs. The buyer is given 12 months time for completing the sale, at which point of time balance amount has to be paid. Following two options are considered: payment of 10 lakhs by account payee check on the date of agreement and 30 lakhs by cash on the same day, and payment of 10 lakhs by account payee check on the date of agreement and 30 lakhs by ECS within 7 days. An increase of 30% of stamp duty is anticipated with effect from 1st April 21. The parties seek your advice, Ayopavam, to plan suitably for reduction of capital gain. Advise them suitably as to what payment mode is to be adopted should the agreement in question be registered. Read through.
Sir, is this a case of approved modes, unapproved modes?
Can you be more clear on what the question is trying to ask us?
Is this a payment like, whether you have to take the stamp value at the date of registration or at the
that is
or date of agreement?
That is what the question intends to ask us.
Section, yeah.
You're right.
I think 40 தெரியல சார் செக்ஷன் தெரியல.
Question number 48. According to section 50C, in case of sale of immovable property, full value of consideration will be actual consideration or stamp value, whichever is higher. Actual consideration or stamp value, whichever is higher. However, where the stamp value does not exceed 110% of consideration, then actual consideration will be taken as full value of consideration. This is the law. On the question as to which date stamp value is to be adopted, the law specifies. On the question which dates stamp value should be adopted, the law specifies where advance is received through approved modes, stamp value on the date of agreement, where advance is received through unapproved modes or advance is not received, stamp value on the date of registration. Advance includes whole or part of the advance also. In the given question, stamp value is specified to get increased by 30% between the date of agreement and date of sale. Hence, it will be beneficial for the assessee to pay or receive the advance through approved modes, as stamp value on the date of agreement will only prevail. In the given question, the question says stamp value might increase by 30%. So with that problem, it is better always to receive the advance through approved modes, because stamp value on the date of agreement will be lesser, and that will be better for the assessee. The deemed consideration might not come. Agreement to sell need not be registered. Only the final agreement needs to be registered. The next question. Talavar owned acres of land purchased in 83-84, converted into stock in trade, recording a value of 50 when the fair market value was 65, spends 31 for construction and 245 for various approval. Starts developing in March 20. In April 21, enters into an agreement to sell 2 houses for 40 lakhs each and receives advance for house 1 in cash, house 2 through check. We can consider it as account paid check. Stamp value on that date for each house is 35 lakhs. In Feb 22, he completes the property into 4 houses. Out of the balance 2 houses, one of the house was sold for 51, stamp value on that date 45 for each house, and the other house was converted into asset for office purposes. Out of the sale consideration received, he invested 50 lakhs in NHI and 50 lakhs in REC. Determine the year of taxability of the conversion and the sale of the amount chargeable to capital gains and PGBP. What will be the tax consequence if the house which was held as asset is sold after 2 years? It's a comprehensive question. First read through. When asset is converted into stock in trade, it is regarded as transfer. When an asset is converted into stock in trade, my dear friends, it will be treated as transfer. Capital gain will arise in the year in which stock in trade is sold. It is not in the year of conversion. It is only in the year in which stock in trade is sold. Fair market value on the date of conversion will be treated as full value of consideration. Fair market value on the date of conversion will be only treated as full value of consideration. These are important to understand. These are important to understand, my dear friends. Asset converted into stock in trade, okay, it is a transfer and fair market value will be. So why it is important to understand, I know you have understood, but in presentation also, when you are answering the question, write the law, state the obvious is the always the principle we should remember. So write the theoretical part of it first. Okay, in the given question, asset was converted into stock in trade in the financial year, okay, converts it in 1920. However, such a stock is sold only in the financial year, okay. He starts developing in April 21. He enters into an agreement, and in February 22, only in the financial year 21-22. Hence, capital gain and business profit arises only in the financial year 21-22. Capital gain and business profit arises only in the financial year 21-22. Section 54 EC, investment has to be made within 6 months of sale of stock. Not from the date of transfer. The transfer has already taken place, but from the date you sell the stock, if you invest, you will get it. You should write the theoretical answer. Please communicate to the examiner that you know the provision and then start answering. Full value of consideration, that is fair market value on the date of conversion. Full value of consideration Nothing but fair market value on the date of conversion is 65 lakhs. I'll take this 6,10,000 itself and compute 142,000 value is not given. Okay, old question. 5 years back, base year was 8182. 5 years back, base year was 8182. So at that time, the question came. In the future question, they will give you. But as of now, I will take 6,10,000 itself. Into numerator 2019-20 into numerator 1920 289 divided by 100 base year. I'm going into business profit. I want your concentration before you can even take it up later. First, let us understand computation. Okay, computation of sale consideration for business profit. Adukapram we will find out business profit. This is the most important. Okay, what is the provision? Same like 50C, section 43CA. Okay, house 1. Okay, house 1. Let us understand that in April, he starts to develop in March 20. In April 21, he enters an agreement to sell for 40 lakhs each. receives advance of 10 lakhs for house 1 in cash. Okay, right? Advance received through unapproved modes. Advance received through unapproved modes. So what happens? What happens is like this when advance is received through unapproved. Okay, actual sale value, we all understand that as 40 lakhs. Stamp value on the date of registration. When advance is received through unapproved modes, I will only take the stamp value on the date of registration and not stamp value on the date of agreement. On the date of registration, the stamp value is 51. Stamp value on that date is 45 lakhs. On the date of registration, the stamp value is 45 lakhs. The stamp value is 45 lakhs. 110% of actual sale value is into 110%. Since stamp value exceeds 110%, stamp value should be considered as sale consideration. Okay, so for this property 45 lakhs, house 1, I will take 45 lakhs as sale value. You can take down this slowly, patiently, neatly in a language you will understand. Actual sale value 40 lakhs, stamp value on the date of agreement. Stamp value on the date of agreement, okay, 35 lakhs. So let's not even worry. Actual sale value will be considered. House 3 is only after completion the sale takes place. In February 22, he completes 51 lakhs he is selling it for. And obviously this is just 45 lakhs, so that doesn't bother at all. Actual sale will be taken. House 4, I want you to understand this, where stock is converted into asset according to section 28. This will be treated as business income. This will be where stock is converted into asset. It will be treated as, sir, originally it was an asset converted into stock in trade, now converted back into asset. Your mistake. This will be treated as business income. Fair market value on the date of conversion will be taken as sale value. Fair market value on the date of conversion is taken as sale value. House 3, which is sold on the same date, okay, is for rupees 51 lakhs, which will be taken as fair market value. So this is also 51 lakhs. When stock in trade is converted into asset, my dear friends, it will be taken as if it has been sold. When stock in trade is converted into asset, it will be taken as if it has been sold, and the computation will be like this. FMV on the date of conversion will be taken as cost and construction cost. He spends 31 lakhs for construction, 245 for various approvals. 31 plus 2 lakh 45,000. Stock converted into asset. The cost of asset will be FMV on the date of conversion. In the given case, 51 lakhs. If it is a depreciable asset, then depreciation will be provided, and when sold, it will result in short-term capital gain or loss if the block ceases. If it is a depreciable asset, then depreciation will be provided, and when in the year of sales, we will get STCG or STCL depending upon, provided the block ceases to exist. Provided the block ceases to exist. If it is a non-depreciable asset, from the date of conversion into asset, the period commences. From the date of conversion of asset, we will start the period. The period commences. Okay, I mean the holding period, sorry, not just the period. The holding period commences. If it is an LTCA, then it will be indexed and COA will be, ICOA will be identified. Patiently look through the answer. It is one of the stunning questions where we got to know, recollect lot of provisions. Okay. As I was telling you that except this firm dissolution, that alone will wait. Otherwise, we have completed this chapter in its length and breadth. In its fullest length and breadth, that you can be very confident if you rework and read this, you will be able to answer capital gains chapter without any doubt. If you are able to spend time on this, more than sufficient. more than sufficient. Okay, all the questions, we have covered all the provisions while we are doing the questions. We have ensured standalone basis also we covered the provision, comprehensive basis also we covered the provision, we covered the exemptions, we covered the taxation. We now know what are all the special principles of computing capital gains and various other aspects. So be confident that this is why aren't we providing depreciation for the office of it as business expenses? Sai Krishna, I got your doubt. Just I have worked out how to compute the business profit here. Okay, and that's why I stopped with the gross profit. I have not even proceeded because there will be a lot of business expenditure. That's why I stopped with gross profit. It's an overall understanding. The whole point is how to determine the sale consideration. Yes, if it is, it depends upon whether it is considered as what type of stock. Residential property now 5% if it is given as staff quarters, etc., or if it is used as an office 10%. That informations we can keep it aside. The intention is to understand this as a very important step and also to get the gross profit. I agree with you that in that year itself for less than 180 days you can provide depreciation. I got your point, Sai Krishna. Coming back, friends, so we have completely covered end to end the capital gains chapter. Okay, 45. Okay, now it will be very interesting for you, and when we do the theory, I will again prove you this particular point. Okay, actually. I can just give you this table and say capital gain is over. Now, if you look at this table, you will be able to understand and appreciate this table in a much bigger manner. Initially, this table would have been difficult to understand. After completion of table, if you look at this tables, the first 15 pages capital gain will be over, friends. First 15 pages you can easily complete capital gains when you are revising. Okay, this table will now look better for you. Okay, in every regard, how things are computed. Similarly, when I go to cost of acquisition table, now this table will be more relevant for you, more interesting for you to understand. One minute, an urgent call. So it is clearly to display that first 10 pages, 15 pages, you will be over. All these things only we later worked out. That's why when we did this table, I was telling you, don't get worried. When we do this as a main question, you will be able to better understand. And that's what when we do the main questions, you will be able to appreciate the various questions, how gift changes, how this Tesla is applicable. All these things you were able to understand because we are and the shares table. So the first 15 pages will give you a greater idea, and in the revision sessions, I will further consolidate the table and give it to you in a very capsule format. I will also consolidate the exemptions in a capsule format to just 10 pages. You will remember the whole of capital gain. Only that we fear that the chapter is so big. Actually, the chapter is small and logical also. Why numerator changes? CII of the year of transfer. Transfer conversion. Transfer compulsory acquisition. Transfer is extinguishment. Only I am later taxing it. Divided by asset first held by the assessee. Then the various components of 50 CA, 50 CB, I mean 50 B, okay, all these things are a compilation, my dear friends. All these things are just a compilation of the various aspects we studied. Okay, right? So, but do not worry, we are not saying that it is not at all repeated. In every chapter, there will be capital gains. More so when we are going to do assessment of individuals also, I will again work out some questions, some provisions of capital gains to recollect at that point of time. But with all this knowledge and with the case laws are also not like business or profession. Here it is simple case law, straightforward. Now, in the case law, if I don't give the judgment and ask you to be judgmental, you would have got the same answer as the High Court or Supreme Court has pronounced. Only the reasoning. Now you know that reasoning. One-to-one correlation, not essential. Superior principle is investment and not anything else. Okay, those type of reasonings you will be now able to do. Okay, so capital gains technically, seemingly a lengthy chapter, can be boiled down to smaller levels, and then comprehensively when we understand, we are clear. We should remember 50C, 43CA, and very soon we will do 5610, which are all integrated provisions, which leads to one. In fact, it goes up to section 194. Okay, section 194, where TDS for immovable property sales is also covered. So it is all integrated provisions. Okay, and in that manner, if we understand, the chapter becomes interesting as well as simple. Okay, with all these things, I am moving out of capital gains. Today, we will do dividend at least to a little extent, so that we are really crossing a part of IFOS. Okay. The next head, this is, if you ask me, sir, will there be question on IFOS? My answer is yes and no. It will not be a standalone question. Majority of the times, capital gains is the standalone chapter and PGBP. PGBP might even be combined with assessment of firm, assessment of companies, but capital gains, standalone. Ana IFOS la there will be questions like in PGBP on the credit side, interest, on the credit side, winnings, those type of only, and it will not be a standalone question. But in the last 2-3 exams, it is not dynamic. Before that, they were quite often testing on gift. Quite often the provisions were testing on gift. So I thought we will understand IFOS once and proceed. So our journey in the classroom started with 28. 28 to 44 we saw PGBP. 45 to 55 we saw capital gains. And we start with section 56, the basis of charge of IFOS. The basis of charge for income from other sources. Any receipt which is not specifically exempt. First condition is there should be a receipt of revenue nature. All receipts are not income. We all know. All receipts are not income. Receipts of revenue nature is only income. I get a loan from my friend. It is a receipt for me, but it is not an income for me. It is a receipt for me, no doubt, but it is not an income for me. All receipts are not income. Receipts of revenue nature will only be treated as income. Any receipt which is of revenue nature, which is not specifically exempt, which is not specifically exempt, which is not taxed under salaries, house property, business or profession, capital gains, is taxable under this head. That is what is the basis of charge. Basis of charge itself says it is etc. income. Basis of charge itself says this is a residuary head. Residuary means all other small incomes. Any receipt which is regarded as income. The receipt should be treated as income. Share capital is not an income. Loan is not an income. Debentures are not income. But those are all receipt. So any receipt which is treated as income, which is not exempt under 10, agricultural income, income da. The other 4 heads does not tax it. So in this head it is taxable. No, it is exempt. Share of profit, income da. Other 4 heads are not taxing it. Is it taxable in this head? No, it is exempt. Any receipt which is treated as income, which is not specifically exempt, and which is not taxable under salaries, house property, business or profession or capital gains will be taxable under this head. Will be taxable under this head. அதோட முடிச்சிடலாமா? No, the law says, let's give a list also. Let's give a list also. In that, the first item is dividend. From financial year 20, the provision has changed. So for you, no problem at all. You are reading the new law only. Don't worry. Dividend received from, be it a domestic company, foreign company, cooperative societies, are taxable in the hands of recipient. The dividend received from business trust, we will see in business trust chapter. Dividend received from, be it a domestic company, be it a foreign company, be it a cooperative societies, are now taxable only in the hands of recipient. DTT la, it's gone. Only in the hands of recipient, and one expenditure can be claimed. So please remember, collection charges la claim panna mudiyadhu. Interest ku claim pannalam, but here you cannot claim. Only one expenditure can be claimed. What is it? Sir, I borrowed money to invest in the shares. I borrowed money to invest in the shares. Whatever I receive from shares is my income. Whatever I pay as interest for the borrowal is my expenditure. Only interest on loan taken for investment. What is that? For making the investment in the shares, you should have taken the loan, and for that loan you are paying interest that can be claimed, that too restricted to 20%. Actual interest or 20% of dividend received, whichever is less. Actual interest or 20% of dividend received, whichever is less, can be claimed. Loan taxable? If you receive loan, is it taxable?
No, I guess it should not be.
No, sir.
No,
Why
sir.
no?
Sir, it's not an income.
It
It's a
is,
Capital
revenue.
receipt, sir.
it is only a receipt, it is not an income.
Revenue.
Yeah. இப்போ ஒரு எக்ஸாம்பிள் கொடுக்கிறேன். It is a private limited company where you and your father are only directors. The private limited company pays you salary. அது உனக்கு taxable?
Yes, sir.
Yes.
Yes,
Good.
it's taxable.
Yeah. The private limited company pays you dividend. Is that taxable?
Yes, sir.
Yes.
Yes.
So, thanks. So, what happened is the private limited company is a glorified partnership. We all know it's just a glorified partnership. So, if I get salary, it is taxable. If I get interest, it is taxable. If I get dividend, it is taxable. On the other hand, I understood loan is not taxable. So, what I did, I took loan from the private limited company. It is after all my company. All practical purposes, though you have separate legal entity, etc., etc., as the concepts, but for all practical purpose, I decide I take. I took loan. I took loan. The loan, we all know loan is not regarded as income. So I took loan and never repaid that loan.
It is deemed dividend.
That's where I am leading to. I never repaid that loan. So what happens? It was all along going non-taxable. People were trying to plan like this. So came a concept. Deemed dividend. Supposed to be. Deemed means supposed to be. Supposed to be dividend. There are some types of payment which are supposed to be dividend. Enna Sudha, have we studied so far anything like that?
I think we did a provision like this in PGBP1 adjustment, sir.
Okay.
So it's not PGP. I think during liquidation or this thing.
That is.
Liquidation.
That's what I am waiting. During liquidation, what is full value of consideration? When we read about liquidation under section 46 of capital gains chapter, when we were doing full value of consideration, proportionate share of reserves which the shareholder gets. In the black limited no ஒரு question work பண்ணிருப்போம். Air is tubes. Okay. Couple of questions we have worked. Will be taken as deemed dividend. Okay. So, section 2 subsection 22 has deemed dividend. Any distribution releasing the company's asset, any distribution of debenture stock, deposit certificate, bonus to preference shareholders. Okay, bonus to equity shareholders is not deemed dividend. Preference shareholder distribution on liquidation of a company, which we have seen, reduction of capital. These are known as deemed dividend. And then came the fifth thing, which is till date one of the very, very, very difficult provision in the practical circumstances. Highly discussed provision. Okay, what is that? Loan or advance. Okay, first listen. Okay, for later I will I just use this page. Later I will take it off to some other page. First listen. Loan or advance provided by closely held. Law, they will not say closely held. Company in which public are not substantially interested. Company in which, okay, public or not, are provided by that to a substantial interest holder or related parties, okay, will be treated as deemed dividend. Lot of things to understand, I know. Loan or advance, okay, I think I have copied it again, sorry. Any loan or advance given by whom, a company in which, public or not, substantially, private limited companies, unlisted public limited companies, private listed limited companies, unlisted family organization. To whom? To a shareholder who is the beneficial owner of 10% or more of the voting power. In all other sections, you will see it as 20%. This section alone, it is only 10%. To a shareholder who is owning 10%, to a HUF, firm, AOP, BOI company in which shareholder have a beneficial ownership of at least 10%. Enough starting word. What is the starting word? To a HUF. Can there be any more clear provision like this? To a HUF or a firm or a AOP or a BOI or a company in which such a shareholder na yaru? The one above, who I have spoken above, okay, in which such a shareholder means who is holding 10% is also holding 10%. I am holding 15% of A Limited and I am a partner of a firm in which I have 20% profits. Company and the firm are now related parties. Shall I repeat? I am a 15% shareholder in the company. Now, substantial interest holder, yes, for the purpose of this section 222E, 10% or more is substantial interest holder. Yes, I am substantial interest holder. எனக்கு loan கொடுத்தா, is it taxable in my hands as deemed dividend? Yes. So what I do is, you don't give it to me directly. You give it to a firm in which I am a partner. From there, I will take it as drawings. So the company lent to the firm. The law closed that loophole saying to a firm, company giving to a loan to a firm in which such shareholder holds 10% or more voting power. அந்த கேட்டிங் க்ளோஸ் பண்ணியாச்சா? Can the company provide to spouse, to any friends, to any relative, to any person by or on behalf of or for the benefit of such a shareholder? All doors closed will be treated as deemed dividend. Don't try to take loan and escape from the net of taxation. As simple as the procedure. Why it became complicated? Because people started using the loopholes. So the lawmakers have to keep on adding and complicate it in such a manner. People think now it is out. So many. Reverse only happened. So to a HUF, okay, a case went up to Supreme Court. Gopal and Sons, sir, Supreme Court, which means 15 to 20 years ஆகும் judgment. Whether loan given by a closely held company to a HUF is a deemed dividend in the hands of the HUF despite the fact HUF cannot own share in its own name. Lawவே beneficial ownership the concept தான் யூஸ் பண்ணுது. If this question is asked without any case law, the whole of this class will say yes. When I read the law, it is very clear, but it has gone up to Supreme Court. 15 years argue பண்ணிருக்காங்க சார் இந்த விஷயத்துக்கு. The loan amount will be assessed as deemed dividend under 222E. The court observed that if HUF is the shareholder, then provision directly apply, and if Karta is the shareholder, then HUF becomes a concern in which Karta has substantial interest. In either of the scenario, the loan is taxable. As simple provision, sir. But it has gone up to Supreme Court. You can imagine. Okay, majority of the time cases are not pending just because of the system of law. Majority of the time some of the cases should not have even entered High Court is going up to Supreme Court. Coming back. So any loan or advance given to directly to the shareholder, indirectly to the shareholder, how? To the HUF, firm, company, AOP, BOI in which the shareholder is having 10% or more ownership, or any relative of this shareholder which will benefit the shareholder is treated as deemed dividend. Two exceptions. Two exceptions are there. One, if the company's main business is lending and it has given the loan in the normal course, நீயும் ஒரு customer எனக்கு, you are also a customer for me, so I am giving a loan to you. Company law says dividend can be only out of profits. So where the company has accumulated losses, it will not be given as treated. However, in the following cases, even such loan or advance shall not be treated as deemed dividend, where the company has accumulated losses, where lending money is the substantial part of the business of the company. Once more shall I repeat, lending money is the substantial part of the business of the company. This became a case law. ஏன் ஒரு manufacturing company in their main objects incorporated lending also as a main object, gave loan to directors. Saying, sir, you can see, sir, my main object has lending. The law reads, where lending money is substantial part of the business of the company. The income tax law and the code clarified, lending main object irukka kudadu. Your business should have substantial holding in, substantial part in money lending business. How do you determine, sir, substantial part? Turnover. Your turnover is 10 crores. 9.5 crores out of sale of product. 50 lakhs out of interest. Sir, lending is my main business. Will you accept? A substantial part of turnover, இல்லையா? Substantial part of capital, இல்லையா? Substantial part of asset, or substantial manpower should be in that business. Law is very considerate. Court has said, I will give you a larger space. What is substantial part of the business? Percentage of turnover to total turnover, percentage of profit to total profit, percentage of asset deployed, capital employed or manpower can be the basis. Anyone can be the basis for determining whether substantial part of your business is lending. How do you say that my business substantial part is lending? உன்னுடைய main activity la let the major. Today what I am talking, no, substantial activity, substantial part, international taxation la kondu poi I will finish this. Poem or concept we will read. Place of effective management. If the substantial part, till then it is going to continue. The substantial part is not just a bookish provision. It has a larger implication to come. Okay, right. Okay, so these are deemed dividend. In this, again, provision or purpose you have understood. I gave you the background. You should not take loan or advance and try to escape from the net of taxation just because it is so. So it is going to be liberally interpreted by law also. None of the trade loans are considered as trade advance. அதாவது me and my subsidiary means 51% I'm holding, so relationship subsists. We also have creditor debtor relationship. For supply I am giving advance. Trade advance will not fall under this provision. Ambassador tours and travels no case. Hotel, they are in tourism business. So that hotel, which is the parent entity, will book for tourists and to take this tourist outside to various locations. 15 days trip to India. They have a travel agent to take them across. And the travel agent has to book lot of tickets. So they gave advance. Income tax department taxed that advance in the hands of the recipient as deemed dividend. Law said no, this is a trade advance. This is not with the intention of loan or advance. This is a trade advance. The first couple of case laws, first case law, we have seen in while working PGBP. I gave you a small hint. In that, if I am right, commission paid to a director for additional work or for securing some orders, no adjustment or question we have seen. In that I told you, yes, he is doing some additional work, so he is paying commission. If it is in excess of FMB only, we will disallow, otherwise it will be allowed. Sir, for a case, director gave his personal property as bank guarantees for collateral for the bank loan. Once more, director gave personal property as collateral for the company to secure bank loan. இப்போ director is in need of money, so he goes and tells the company, and the mortgage clear பண்ணி கொடுத்தீங்கன்னா I will at least sell the property, I'll mortgage and get some money, can you clear the mortgage? The company said, boss, using that we have got a bigger loan, how much you want, I will give you. The company gave money to the director as loan. Income tax department taxed them as deemed dividend in the director's hand. Director said, I am not getting it without any benefit. My property is there with the company. My property is there with the company. So you cannot take it as if I am doing it for the loan or advance received. So there is a benefit which the company enjoys, because of which they are paying additionally this money to me. And the court upheld the director's aspect and said, yes, this will not be treated as loan. Pradeep Kumar Malhotra, advance given by the company to the assessee shareholder by way of security deposit for keeping his property as mortgage on behalf of the company to reap the benefit of the loan. Can it be treated as deemed dividend? Section 222E must be construed to mean those loans and advances which a shareholder enjoys simply on account of being a person who is a beneficial owner. I decide I take. Where the company gets any benefit and the loan or advance is given to enjoy such benefit by the company, then it cannot be treated as deemed dividend. In this Pradeep Kumar Malhotra case, assessment of companies, two questions we will quote this case. They will say, director is given money because director's property is mortgaged. We will quote, according to Pradeep Kumar Malhotra, for the director, this is not taxable because it is not a deemed dividend. One other case law. I took a company, here is company, took a shareholder's property on rent, okay, and that is a house property. So I spent 2 crores on repair and renovation of the property to make it office. Income tax department, the assessing officer taxed it as deemed dividend in the hands of the shareholder, saying, you have got indirectly benefited. On behalf of you only they have spent. For which the court said, no, that person is not getting any money. The company has really taken the property on rent and they are speaking Vikram Veer Bait. Money was not paid by the company as advance or loan to the shareholder. Amount spent is for repair or renovation of premise which is occupied by the company, even though the premise is owned by the shareholder. It cannot be regarded as payment on behalf of the shareholder, hence deemed dividend provision will not get applied. And none of the trade advances, so many cases, Ambassador Tools and Travels, Creative Drive, Amit King, Atul, everywhere it is trade and trade advances not to be treated as deemed dividend. In the case of Mulkosone, assessee was involved in booking resorts for the customer of these companies and entered into normal business transaction as day-to-day business activity. Advance given by a company to a sister concern and adjusted against dues of job work done by the sister concern. Held the amount advanced by business do not fall under the definition of 222E, sales advance. Advance made by a company to its shareholder to install plant and machinery at the shareholder's premise to enable him to do the job work so that the company could fulfill the export order. Business experience. Security deposit made by the company to its sister concern and a business transaction arising in the normal course. Hence, it will not be deemed dividend. So, deemed dividend, okay, nowadays rare of the questions, the rarest of the questions, but still it can be forming part of an adjustment, etc. Remember Pradeep Kumar Malhotra, Gopal and Sons in the HUF. Trade advance, generally remember, you can quote any one of the 4 cases, not all the 4 cases. Ambassador Tools and Travels, they have said that is a famous case law that you can quote. With this, I end today's class. Meet you tomorrow morning, 6 o'clock. I'll be there physically. Okay. We will meet live as well as physical. All the best, friends.